You want an exposure to a market or an
Everything
asset.
they need in one place.
The world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to Morningstar. I'm Emma Wall, and here with me today to give his 3 fund picks is Marcus Brooks, manager of the Cazenove Multi-Manager Diversity Fund. Hello, Marcus.
Hello.
So what's your first fund?
Well, an area that we find really attractive at the moment is European equities. It's an area, I think, where quite a few investors are still relatively scared because, maybe the European problem hasn't been sorted. And that means for us, it's on a Schiller PE discount that we think is, something we can go for. Now, that means that if you're looking to get exposure to that area, you really need to have a cyclically biased fund, possibly with a value tilt. And in our analysis, an in-house fund, the Cazenove European Income Fund, absolutely fits that bill. It's managed by a guy called James Sim. It's under a lot of people's radar because the fund is only about 18 months old now. It is growing quite rapidly. It's done very well. It's pretty much top decile since it's been launched. And it's got a very pronounced style bias. It's got this value bias. It's an all-cap strategy. It's not a traditional income fund that's super safe, large cap, blue chip, that sort of stuff. Very, very different. And in many ways, it's a European recovery fund. And we think that's absolutely appropriate for the current market environment.
But presumably won't be appropriate forever. So this is one that's suitable for now, for the next year, for the next 2 years?
Well, the way it's currently positioned, absolutely suitable for now. It's had a fantastic run, so maybe it's due a little bit of a wobble, but actually I think it's going to be fine. Now, the manager, James Sim, is not a perma value guy. He will rotate that portfolio, but of course he's got to get it right. So, the decision as to how long you hold it, I think is something you've got to look at very closely.
And that is a Cazenove fund, but you don't have to hold Cazenove funds, do you? Your second fund isn't an in-house fund.
No, so the other area we really like is Japan. Again, another area where people are, I think, still pretty pessimistic about Japan. They're very sceptical about all the reforms that Mr. Abe is trying to bring in. And to us, actually, this is the catalyst that Japan needed. It was undoubtedly a cheap stock market because everyone kind of given up on it. With Mr. Abe coming in, 3 arrows, going to be reform, even the labour market, suddenly that means Japanese companies are going to be able to properly compete in the world. Honda, Sony, Panasonic and so forth. And for us, that leads us to the GLG Japan Fund, GLG Japan Core Alpha, I should say, fund managed by Steve Harker, which has got quite a good, again, Japanese recovery type bent to it. It is large cap this time. Again, a slight value bent to it. It's got Japanese financials in there, some of the exporters, which will clearly benefit from a weaker yen policy, which I think Mr. Abe's policies generally are. And the yen's gone from 76 against the dollar to 102. So already buying a Honda car is a third cheaper than it used to be. So we can see Japan turning around. And I think Steve's got the right portfolio for that environment. That
stock market has rallied significantly this year, though. Why do you think it will continue? Is this not it?
It can continue. I think, to put it in perspective, though, it's the Topics, even after this rally, has underperformed the S&P 500 by about 80% since the lows of 2009. So I completely understand from a perspective of a stock market that's already up 45% or so, it doesn't look like the newest idea out there. But put it in a longer-term context, actually, Japan was so loathed, I think we've still got something to play for.
And presumably a good active fund manager can stock select anyway. They're not exposed to the entire market.
Absolutely. Japan has been one of those areas where going passive hasn't really been the right way to go. Active stock pickers have been fantastic. There are times to own the more mid and small cap type funds, and indeed, actually, they're doing quite well at the moment as well. But the large cap value bent, we think, is the right place to be. That's the bit that's the cheapest.
So Europe, Japan, and what's your third selection?
Something a bit more off the wall, rather than just going completely long only and hoping for some sort of macro economic turnaround. A slightly more flexible alternative fund would be the Majedi Tortoise Fund, managed by a guy called Matt Smith, who's been running it now for 4 or 5 years. It's a bit of a tricky one for listeners to this to actually invest in because it is soft closed. But there's every chance they may add more capacity and may open it up. It's something for Majedi to discuss. Now, what I like about this is it's a fund that can be quite directional. So if the markets are going up, it can actually go pro-market. But equally, if the manager is feeling a bit cautious, which actually he's just starting to, he can pull that net position down. And currently they are flat. So the returns of this fund now are not going to be dependent on the direction of markets. So if we do have a wobble, it should be okay. Now, he can take it net negative, which for me, I think is really valuable. So if the market actually goes down, he can make money. Clearly, he's got to get the calls right. But for most funds, that's unusual. They very rarely actually go net negative. And this guy's got a good record of doing it. Made money in 2008, for instance.
Tortoise suggests this is a slow climate. Is that the case?
Well, Tortoise was a brand chosen by the fund group to suggest, this is slow growth. This is not going to be winging it about all over the place, trying to shoot for 100% type returns. Now, actually, Matt has done a really, really good job over the last year, and the fund is up about 25%, which is unusual. But he has done very well at saying, emerging markets look like they're expensive and about to roll over. Get away from that, but go more developed market, pick up some of these fantastic returns from being more directional, and now just taking profits and becoming more net neutral, if you like. And I think if you can do that consistently and compound those returns and defend in tough times, I think that's a really stunning proposition.
And a great diversifier.
Great for a fund of funds, yes, absolutely.
Marcus, thank you very much.
You're welcome, thank you.
This is Emma Wall for Morningstar. Thank you for watching.